In September, the Fed announced it will start reducing the size of its balance sheet. The Bank of Canada hiked rates. The Bank of England changed its wording, and now an interest rate hike is likely. And finally, we expect the European Central Bank to start tapering, which means actually to reduce the pace at which it's buying assets. So in other words, monetary policy is changing, and we have started monetary policy normalization. This is why we want to focus today on the yield curve and follow 5 different approaches. The first one is the expectation theory. According to this theory, the yield curve actually summarizes the past of short-term interest rate in the future. So you can derive what would be the short-term interest rate in 10 years. And according to its estimate, it could be about 2.8% in the US, which is very close to what the Fed expects. So from that point of view, we cannot really say that the yield curve is too low and that interest rate is too low. There is a second theory, which is called the term premium. And here the idea is as follows. If you are an investor and you lend money to someone for a long period, you expect to have a higher return than if you lend for a short period. But actually, currently, this is not the case. Term premium is estimated and is close to 0, which means that it doesn't matter if this is short or long term. And this is kind of awkward. So based on this approach, we would say that the yield curve is probably too low. There is also a third approach, which is based on the Fisher equation. Fisher was an economist, and according to him, nominal growth should be more or less the same level as interest rate. But if we look at nominal growth in the US in the last 3 years, it averaged 4%, while long-term interest rates were at 2%. So there is a clear mismatch, meaning that interest rate is too low according to this theory. There is a fourth approach, which is called debt sustainability. And the idea is as follows. If you invest in a project, as long as your return on investment is higher than the cost of investment, it makes sense to invest. And if you translate that in the macroeconomic terms, it would mean that as long as GDP growth is higher than the cost of debt for the government, it would make sense to invest. And actually, according to this estimate, the yield curve could rise by about 1 percentage point without any negative effect. So there is still room for upward movement in the yield curve. Finally, the last point is about the non-arbitrage condition. According to that, any investors can, at any point in time, invest either in US Treasury or in German bonds. And actually, because these assets are more or less the same in terms of liquidity and in terms of risk, you should expect to have the same return once the currency hedge is taken into account. And this is actually the case. So it means that interest rates are the same everywhere based on this condition. And because we know that in Germany rates are very low, it means that actually the yield curve is low everywhere in the world. So based on this 5 approach, actually what we can say is that either the yield curve is fair price, or is too low, or has room to increase. Again, this background, we expect interest rate to increase, but not to be as high as they were before the crisis. Goodbye and see you soon.